Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. It is actually Friday, September 1st, a little bit in front of 1 p.m. here on the East Coast, but because I've got some friends and family due in for the holiday, and I've got part of the family traveling, I've got to get folks back and forth to the airport. I'm going to take care of this now for us, and that way everyone can hopefully check it out whenever it suits them over the weekend as well. So let's take care of our trusty disclaimer first, and then we will take care of our trusty intellectual property rights notice. And then we'll get into this week's stream. And it's similar but different, as it often is, to last week's stream. But here it is, and I'm going to leave it up for a while, and then we'll just take a quick peek at last week's stream and come back to this. And that way, if anyone wants to grab a screen cap or so on and so forth, they can. And just as a reminder, there's last week's. And so I'll leave that up for another moment or two if anyone wants to take a screen cap instead of having to pause, but then go right ahead, excuse me, and we'll go back to this one. And let's see if we can shift some things around in terms of where we are on recording. So let me see if I can do a stop share. Pause share, maybe. Pause share. And then switch over. No, we'll not let that happen. Okay. All right. Stop the share. And then I'll get us a different screen here. So I'm going to move this out of our way, and hopefully we can still take a look at it. But I think what I'll do is move to a different screen. We'll cover some of these tabs first. That's not it. I think it's going to be this one here. So we'll cover some tabs first. So with this week's stream, let's see if I can cover this a little bit better up here for now. So we came into the week with a mindset of expect more of the same, meaning volatility. We decided we would play the swing range. And then we said that even though I had a typo in there, we discussed how we thought there was more room to run if they wanted to, and there was also more room to fall if they wanted to in the bigger picture. And we said that the bulls needed to act now. They were under pressure because they didn't want to risk a rough monthly candle being drawn and completed in the SPY, in the QQQ especially. And so with that being the case, let me just double check where we are. Why is Zoom giving me trouble here? Let's see what it's got up here. Let's move this over to there for now. But what happened was, of course, today's Friday. Here's Monday. So we said with the Friday, sort of that, like, wow, that was a really curious save on Friday that we said many decades ago. I would probably have dismissed that because it really to me was very engineered. It didn't seem legitimate. But we've said in recent years, right, maybe like in the last 5 to 10, we've been taking those more seriously, and they've often lasted for longer than just the one kind of initial bogus day. They've been able to string these things out longer and turn them into something at times. And they did exactly that. And we had a lot of counterweights. We had things where we were thinking, well, this doesn't look so wonderful, but this really doesn't look so bad anymore, that kind of thing. And they got the market out of harm's way, right? That's the bottom line. I think if they would have closed, this week below the 100, if they'd taken a different path, it would have really brought about, I think, even more selling and brought about a whole nother leg of issues, right, for this market. But they did a remarkable job in terms of retracing. You can see that little tight retracement grid that I've got up there. And that takes us up to right near the 78.6% retracement. So they nearly retraced this entire sell-off, right, from the late July early into kind of like the latter half of the month. And then that's almost all erased, right? Just on what, right? You're just wondering on what. But that's the way they roll, right? They did use, as we noted in the notes, right? They did take some of those counterweights that we talked about, and those were, which we'll see some more of. We said that there was that percentage of stocks that had corrected. which we'll show again this week. We noted that breadth measures had also corrected, that the fear and greed gauge had corrected, that the AAII sentiment survey levels had corrected, and maybe were bullish because they're inverse and they'd gotten pretty smoked. We also talked about the Friday factor that we just reviewed, where they have this bogus save and it gets extended for at least a day or two. Clearly that happened. We also said there were some improving technicals in a way at the end of last week, that there were some positive divergences in the SPY and the Qs. And we also said they have a propensity, right, or a tendency to rally into long American holiday weekends, which they did. To this point, they did it earlier in the week, and Friday's kind of a little bit of they did put new highs in today, clearly, but it's not all that wonderful in terms of the way it may finish out as of right now, where I'm recording sort of like midday. So the approach we had coming in was just go with the swing high, swing low. When you're between those, just take singles, maybe a double. And if it breaks out, go with it, see what happens. And so that swing low is down in here. Let me just switch over to the pointer. The swing low in the SPY was down here that we were trading against. And then the swing high was last Thursday's high that we were trading against. So we said, go with it. And really, right, we came into the week and this is what they produced on Monday. Sorry, this was Friday here. This is what they produced on Monday. And then here's Tuesday. They broke it out, broke through, right, closed strongly. Something Ryan talks about all the time in terms of, should I hold, should I roll and stay in? Well, if it closes really strongly, I mean, and you have this large range and they close virtually deep, there's very little candle or shadow, and you end up with this, really strong candle finish. That's probably a good bet if you're not super overbought at that point to stay in. Usually you'll get a little bit, at least a little more follow through, and they certainly delivered that. So big retracement, that you really wonder how it was so easy for them to retrace so much of this. You wonder what's going on, right? Is this really just, is this the correction? And are we now about to have another up leg that breaks through? And you could, right? What we said about this time post sweet spot in really AUG, SEP, especially, these are not great months. They're typically volatile. We thought we were due for a correction. We did get one. And like we noted last week, you could still see where the potential for more was there. But at the same time, if we flip over to now back to here, we did note that things like the percent of stocks above the 20-day had gotten smoked to levels where it would not be unreasonable for them to mount some kind of a comeback. Just because, does it have to get super, super low every time? No, it really doesn't. We noted that. And the same thing really happened to lesser degrees, but in the stocks above the 50, that got hit pretty hard. Has more room. We noted that last week, but right, kind of like really severe for a couple of weeks there, that how much damage had occurred. And so that's why you just can't say, well, it's straight down, straight down, straight down, because these things usually have wrinkles to them, right? There's different inside of larger moves, there's counter moves and things like that. So here's the percent of stocks above the 200. This is the one we said had probably the most room to fall back towards lower levels that are typically associated with good tradable lows. But to kind of cover what we were thinking this week, I don't often do this, but here's a good look at our Rebel Pit Pro, which used to be just called TNT for those of you that have been around for a while. But what we do is we certainly, of course, have biases of what we think a stock looks like it's going to do and what the market looks like it's going to do. And if the market is going to be supportive, then we definitely think, okay, we think Apple probably breaks out. But because we were market makers for such a long time, we know that you don't really want to have a one-way situation on short-term trades. You really want to have more of an opportunistic mindset. And if they decided to take the market down for a couple of days, we want to be able to participate in that and make some money. So we try to prepare on either side with trigger levels. We really thought Apple looked really good to move higher this week. So we did go with Apple. Our trigger level, the stock closed a little off Monday's high. So we used Monday's high as about 40 cents away as the trigger level. And that stock, I don't know where Apple traded up to, but I do know that it traded I think it traded almost to 190. So to be able to get in $1.85 call initially and be able to have a move like that, especially late in August, I consider that a very nice development. I'm trying to pull it up right now. Yeah, it got to 189.92. So I think this one's over here. Yeah, it is. So there's your 189.92 high right there. So yeah, I mean, you get a little bit, I guess, roughly right, a $9 move. You really have to be happy with that kind of a move in late August, right? Right before the Labor Day weekend. So that broke out really on Tuesday and it just never looked back. It just has kept going. And that was a good focus name for the week. But what we typically do is we include a few names, right? Because we don't want to have one analyst comment or some news development sort of upend a good idea and then have folks that are in the services not have anything else to go to. So what we try to do is create a mini short list. And that mini short list includes usually 3 extra names. And in this case, we had Roku, Spot, and Google. And I think we'd have to go back and probably look here to see where the trigger levels were. But 77.82, I think Roku was the worst performer of the 4 in terms of delivering opportunity. The trigger was 77.82 on that one. Let's see where Roku got to, just out of curiosity, because I was keeping an eye on these things. We have the whole team really trying to keep an eye on this, but we have one person that's mainly responsible for most of those updates, and just keeping an eye on things through alerts. But yeah, this got to, wow. So this got to 82.47. So that's almost a $5 move, right? So that's not a bad move, right? Really, really isn't. Had a nice strong Tuesday. I think that's a Tuesday push, just like the other stocks. So that was a good one, but really the other, I mean, it wasn't too bad, or it was solid at the very least. But I think the other ones were better. I really like Google. Google came in really, I think, second in terms of, if we didn't go with Apple, we probably would have gone with Google. But we also really like Spotify, and that turned out to be stellar, because I think that turned out to be let's see, where's that at? It's not coming back up there. Over here. Yeah, so Spotify, we were at 142. Google, we were at 132 in terms of the breakout level. So let's see where that got up to. So we were at 142. This thing traded up to 158. So that's a $16 move through. And you can just see, like, in terms of being a roller with as strong closes day after day, that was really nice. And one thing that drew us to that was this potential for gap closure, and that's something that we kind of ignore it until the stock starts swinging back and it's kind of in the general neighborhood. And then we're more apt to say, yes, this is definitely something it could be drawn to. And I think it was in the weekly ATR of the name itself. So that's kind of one of those things when, like, everything kind of aligns and works, and you're like, okay, well, that's kind of how we drew it up, right? But it's not always like that. I mean, that's the thing. That's why we've got several names in that kind of a service for folks to potentially trade for the week. And we also have, the ability to go long and short, just in case, right, macro developments or what have you really shift things around. But Google was another one we said get in near 132 and change in terms of the trigger. And I do think on Tuesday it closed above there. Let me see. Yeah, it did 134.57, traded all the way to 138. So that was almost like a $6 move. So that was also a good one. And so what I'm getting at is these have been some really strong moves in a lot of different stocks. And so now that we've really jammed as much as we have in some of these names, I would not be surprised to see if there's a little bit of a pullback, especially because today we're getting a rally in the TNX, we're getting a rally in the dollar DXY on Thinkorswim. And so we've been telling everyone to keep an eye on those, because the market really acts inverse to those overall, or they act inverse to equities typically. And it's not a perfect automatic correlation at every moment of the day, but overall. But the market started out strong. Those two names, they really jammed And since they jammed, the market itself has been struggling. So a lot of those early gains were wiped out. And I can show you the big move in dollar DXY right here because it's part of our discussion anyway. But you'll see how this really found support where we would expect it to. I believe there's going to be a flat line that shows up on here once we get, yep. So that orange kind of flat line that we're looking at found support near there right after kind of backing up and got above there. And now it's really powering, and really it's close to the highest close that it's had, right? So suddenly the dollar DXY, or just the US dollar, is back, right? And that's not good typically for equities, typically not good for precious metals. The other thing would be the TNX. So let's take a look at that. Now that did find support also where we've been discussing it in macro measure, and well, a little bit in sector situation. So that also had, you can see there's a line right there, that orange line that I've got, and it did back up to there. And now it's trying to reverse from there too. So as part of our stream notes this week, right, I would still keep your eyes on these. I think these are really important to focus on right now. This is them really ramping is what back in here is really what helped start to bring about the market's corrective activity that we saw from later in July into really mid-Aug. And they then topped out. And since then, the market, of course, the last 2 weeks has been doing better. So that's why I continue to harp on those. It's still there. Interestingly, while we're here, we may as well cover the major index ETFs before we wrap up today. But the VIX, this might end up with a 12 handle on it. I was talking to Ryan in a webinar earlier this week, and I just said, would you be surprised if we end up below, basically below 14? And I should have said below 13 because it's really working its way lower. So despite really some, I think, rumblings out of yields, rumblings with the dollar strengthening, once again, the VIX continues to be beaten down on. But that's the kind of moves we saw in these names. And so when you get really good moves like that and you retrace as much as we did, that tells me, right, that's kind of enough. Like, I'm not saying we're done, we roll over. I'm just saying that brings that possibility on more, because probably a lot of people may have been caught off guard by what happened here. And we'll have to see. So I don't think we can get much more out of this particular tab right here. This tab, though, is worth noting. If you look at it, right, the 2-year yield is just off the highs that we discussed last week, right? So we were discussing them last week, and then I think earlier, might have been earlier this week, that we started to notice that it was moving up, but they backed off. Anyway, the yield's still really close to the highest recent high in some time. The target probabilities have shifted. They're now treating sort of like bad news is good news type of a thing. That is definitely perking up. And you can see that the expectation is that we sit tight. So things have flipped around a little bit. The probability now favors that we sit tight and do not go up even at the November meeting, right? So keep that 20th on your calendar. Usually, right, they work things up into a nice little frenzy in front of the Fed. That's been the trend rally into the Fed for a while now. As we noted, right, just go back to 1 week ago and you were down here in fear, right? So we were noting that, hey, this might be enough, and weren't sure if it was, but it turned out, at least for now, that it was enough. And then interestingly, we did cover this last week, like we typically do in terms of our tabs. We're almost done with the tab review, but basically you can see right there that the AAII sentiment survey, that really is still down there. And in terms of bullishness being subdued from its normal historical average, you can see the bearishness is still up there versus its average. So to me, like, this helps bulls a little bit more. So we'll talk about the technicals shortly, but I really, this situation isn't helping bears in my book right now, because there's just too much there's just a lack of bullishness, too much bearishness versus historical averages. So probably a little bit of a helper to the bulls. The other thing I would note is that we did see some major UOA activity in terms of the SPY. Let me try to bring that up, and then we'll get back over to our stream of consciousness discussion and the charts. But I just want, if you're not in some of the services that we covered this in, just note, right, look at this week. It's been, and well, late last week too, but there's been quite a bit of larger trades piling up in here. And I think we had some Qs, we had some IWM as well. I'm not going to go into all that, but some of these things are pretty big. I noted this, that, you know, a lot of people feel uncomfortable trading with the when the paper is ostensibly bullish or bearish. They have a hard time taking the other side. But I tried to demonstrate, right, that we saw all this put buying and really like right in front, and as this market was about like rallying strongly, as per, you know, the Apple, the Spot, the Google, and of course many other names that were out there this week. So a lot of times what these guys will do is protect themselves, you know, they'll add longs through shares, and then they'll protect themselves just in case with these big purchases or rolls that they do in some index ETF puts, major index ETF puts. So just keep that in mind, right? In terms, I do think really that open-mindedness helps you. If you look at the UOA and say, look, if we're not in a roaring bull market, then it's not as easy to tell, right? If you see a lot of slightly out of the money call buying in a roaring bull market, that's probably bullish, right? But for me, when you get into a market like this, where are we back in a bull? Are we still in a longer term bear that has it on their leg to go? I don't know. I'm not convinced of anything quite yet. So given that, I'm really willing to just go with the fact that there is paper. It's pretty significant paper. It's telling me more than likely someone's doing something now in this way for a reason. And I'm willing to expect that there's going to be volatility, and I will jump on it in whatever direction it begins to unfold, because I can trust myself as a disciplined position manager that if that isn't working, I'll shut it down and even possibly reverse it. So let's switch over to the view that we need. And I think if I do, let me see if it's stop share, and I'll get a new share going here for us, and then we'll discuss things more. But I think I just need to move something around here. So let's see if it gives me the right screen now. I want screen number 3, share. I think it's working. Yep, I think it's working there. So that we ended up on the VIX. So let's make sure we're covering our stream commentary. I just kind of covered that we did have that breadth correction. I didn't cover that part, but we did have a lot of percentage of stocks that corrected. Talked about the fear greed. We talked about that Friday factor, the holiday weekend. And then we said, right, that they've used the news this week to really move things up. The news reactions were, okay, no matter what happens, it's positive. And that's usually, right, indicative of when the bulls are in control, regardless of what prints, right, they just buy anyway. So that is a little bit of a lean towards that the bullish mindset is still there. And you could argue that in 2 different ways. You could argue that's because we're in a longer term bull market, and some people know that in their minds already. Or you could say that needs to be quelched or squelched or spiked on or stamped or whatever you want to call it before, right, that this market really can go up in a big way. So we'll see. But we talked about that swing low, swing high approach and breaking above it, you know, and those short-term trades, like I'd noted, though, a lot of our trades worked out extremely well because they broke them out. They broke the indices out of the range, and the stocks just went with it, and there was no looking back. So that's what can happen, though, late in the summer, maybe some thinner trade, maybe a desire to not have the August candle end awfully, and they kind of won out that way. We talked about we did our tabs check. Let's see if we can do a quick view of one other thing I wanted to show. Bring this over here. Let me just double check that I'm showing you all the right stuff here. Yep, I am. And I just wanted to note that we'll talk about sector situation a little bit, but a lot of the leadership sectors kind of roared back, right? The the XLC roared back, the XLK roared back. A strong sector like XLE has continued to move up, and that made a new high. Some other things like staples, that's been in trouble. XLU is in trouble, and XLV, they're not faring all that well. So it's almost as though we got a little bit more of a risk on again. And I wonder if it's sustainable. I'm not convinced that it is, but they're certainly not going for defense when they're the staples of healthcare, utilities are all really getting hit hard, along with the fact that the VIX is almost with a 12 handle on it. So that just kind of gives you an idea that the market doesn't seem worried. And that probably does have a lot to do with the fact that this is a long weekend as well. But you could come right back early next week. But as of now, right, I can understand why this is happening. This is usually the way that things end in front of a long holiday weekend. You have a bullish week overall, and then it just kind of stalls any bear stuff out, and then people don't want to carry the theta over the weekend. They start bailing, and so volatility starts to drop. Anyway, so those leadership sectors fared well, but Friday did bring pain to a lot of sectors. We did note that bond yields and the dollar DXY did hold key support, and I still would maintain that if those continue to make new highs, that's possibly going to break this market eventually. I still think there's real risk of that, and the market always does a great job of ignoring that until it doesn't. That's been my experience for 3 decades. So even if you see that coming, you could still be very early. And that's why, again, I would insist on being smart and at least waiting for the momentum to at least appear to have reversed before fighting against it, because these guys are masters of waiting people out. And do recall, right, that if they do start to cut, the Fed suddenly starts to cut, maybe in November or something like that. Who knows? Maybe sooner. I doubt it, but maybe sooner. That's really when the carnage begins in equities, because Ryan had some great graphics earlier this year about it. We'll probably find those again and bring them back, but it's basically the acknowledgement of the Fed that they maybe has gone too far and that the economy is about to get really hurt as a result. So then they begin the process of overshooting in that direction after having overshot in raising rates too aggressively. So just keep that in mind. So when these bulls kind of get what they want and the Fed out of nowhere or starts to telegraph they're about to cut rates, that might have the initial bullish reaction. I wouldn't doubt that, but if after a little while, it can turn the other way strongly. So again, I don't know what the short-term catalysts are. There's still 3 weeks roughly to the FOMC. I don't know, other than the stocks on sale and the fact that the third year performance finishes well by the later in Nov and DEC, we finished this year well according to the third year of the presidential cycle, and even the typical year does. But I'm not sure what else is wonderful right now, but they are taking the old bad news is good news and using that to that's perking things up a little bit. And that if that mindset starts to perk up, it'll be in place until it isn't. And so if you see what's ostensibly bad news hit the tape, remember they could start buy on that news. So it is what it is. I still don't think the dollar and the TNX have backed off enough. So I'll just show that, and it's very clear really in the dollar. I think if we get past Friday's low in TNX and close down there, that would probably be the level at which you need to be under for that yield to not really be scaring the market that much. But at some point it will. And as I noted earlier, right, the dollar is hanging in there. And so you're not too far from the highest close we've seen in several months. And if that's the case, right, I just don't think that bodes well. So keep your eyes on that. Keep your eyes on TN. I continue to urge that for folks that, I know it's hard to watch all this stuff unless you've got a lot of monitors everywhere, but that's why that video card that allows for that, the computing power that allows for that, and then of course the screens that allow for that, I would say that they're well worth the investment. It really lets you get dialed in much more quickly. And things that you should be watching, you don't really lose sight of unless you're really bogged down with things. But here's the TNX, and like I said, I think below today's low, and they start tamping on it, then you're going to feel better about things. But let's get back over to the SPY chart while we discuss things, because this is why I think open-minded charting and being objective is helpful, because I can really make a case that right now that we could see bullish action coming out of this. We could see bearish action coming out of this. And until we start to see more, I'm not going to have that strong, right, that strong opinion. Because you have to admit that despite everything, and probably just with a lot of shenanigans added over the past couple of weeks, until the sell-off that we saw this morning, you were really close to the most recent high. So how weak are you if you're only really one good day away from the most recent high? So you're not that weak at the moment. Now, on the flip side of it, do you have a lower, hold on for one moment, please. Got the old quick phone call there. I apologize. Someone needed to check in with me. But getting back to this, right, I could also see this being a lower high, right, if as time goes by. And so was this really all about just tidying up what was an ugly candle to prevent more selling temporarily because you were able to hold above the 100? Or is it really like them, what they're doing now is, this is the correction, just like we've had other corrections or pullbacks. And then what happens is they hold a key level, and let's just say they held the 100. Now, if you pull back a little bit and you've got the rising 50 there in gold and the rising 20 in light blue, you pull back into there, maybe take some of this run back out of the stuffing back out of that for a little bit, and then continue higher. And that has happened in the market, right, over the last couple of years, really several times. It's very common behavior to begin with. So that's why, right, just kind of thinking a few steps ahead, I think you can see that this could really go in either direction at a juncture like this. I would think that these moves have been so powerful that they do need to pull things back a little bit more. That would be my thought process, that things need to pull back a little bit more. But if they support them and go again, right, then you're really starting to think there's more to the bull case, or at least they're keeping this third year of the presidential cycle performance intact if they're able to do that. But here's kind of an extended pullback, and when they drop below there, and then they came out of that corrective activity and they were able to put things back together again. But that was from an oversold and almost like a loss of trend situation. They were still able to do that. This would be nothing like that. Just to come back into the 50 and the 20, let's just say down, say 2% from here, just to throw a number out there, to 1.5%, 2%. That's no big deal. Just a little pullback, and then really they could be off to the races again. So we have to wait, I think, for more data, because the reality is they had been beaten down pretty good in August. And because of that, right, and some of the things we looked at, some of those counterweights I referred to earlier, I think it helped make this more possible, because they didn't finish kind of at a middling range in August. They were kind of hit down pretty hard, probably were good enough to be considered oversold, and breadth was bad enough, and they pulled this whole thing off. So, and now here you are, right, with that big retracement. There's still room to go to close this gap here, I believe, at 455.49. You didn't quite get there, I don't think, today. You missed that by a little bit. But yeah, I mean, we all know it would take one or two decent days and they'd be right back at the high. So I still say just keep your eyes on the dollar, keep your eyes on TNX and bond yields. And that's really the story. And if those make it difficult for it to go up and it rolls over, you'll understand why. And if the contra side happens, right, the counter case, you'll know why. But if they're backing up big, they'll probably come after this again, because it just seems like the appetite's still there, and you're nowhere near overbought in terms of a bigger picture. In the short run, did you get overbought? Sure. In the intermediate term, no, you did not get overbought. I mean, your RSI in the intermediate term is I'm running, I think, just a standard 14 on this one, but even on that, you're only at 58, right, with where you are right now. So it's not like you're overbought here. You're kind of middling. So nothing special happening, and they're back above all the SMAs. So again, like, it's pretty hard to say that this is doomsday material at the moment, with a lot of things having improved and a lot of sectors having participated. I do still think it's got that sort of hint of dubiousness. What happened here, the timing, I think, was and the way that they went about it was kind of forced, and it almost feels, like I say, it almost feels geez, Thinkorswim's really slowing down here. I mean, throwing in an extra Q for good measure. But I think that's why I'm like not that impressed, because I don't like when everything is engineered for me. It just doesn't seem that natural. But last Friday was engineered, in my opinion, and we noted that this is what they can still do, and they did it, right? So you can't. It's not like you can only trade the times where you don't think it's engineered. I think you should trade when it's engineered, maybe more than when it's not engineered. But it just still has that feel to me. I don't, because my way of looking at it is, right, rates, regardless of what you think in terms of rates not going higher, or maybe rates coming down a little sooner, you're still wrong by a long shot. You thought this was going to happen in April. You're going to get probably to the new year, as it looks now, without anything happening other than you went up from there and held there. And that's a lot longer and higher than you thought back in April, when this whole thing really was being discussed. And by the time the Fed were to get much, much lower, there could be a lot of damage done. I think a lot of damage is being done in this economy in the short term. So whatever the case may be, I'm still not a big buyer of what they're selling. But again, we're always going to trade the charts, because getting the path and the timing is very hard, even if you're dead right about your macro takes, and the money gets made, right, for swing traders in the short run anyway. So that's the talk there. Let's see, the zigzagging. So this kind of back and forth that we've been going through now for about, maybe like a month and a half since we topped out. I would say, like, this could last, right? And just remember, September is not typically a good month. And if we do not take out the high, the other high in SPY, right, that would be related to this Q's high, if you don't take that out and you drop from here, you'll have a lower high in place. That really won't look good. It could produce, again, more volatility, and that's great, because if the VIX stays as low as it is right now and stock volatility stay low, that could be a great trading environment for us. And those some of those moves that we saw in the Rebel Pit Pro that I on our short list this week, if we could keep getting that, I'll be very happy, because that's our goal for subscribers, is to find good opportunities, very reasonably priced options, good technical setups that are ready to potentially move strongly, at least in one way, if not two, and then just go along with the market as long as the stock's acting in accordance with the market. That's in a nutshell, what we're trying to do. So I would expect more of the same. My question, as I got to earlier, is, do they come down here and find support, right? And does it hold? And if it doesn't hold, you all know that's not good. And if it does, right, if it does we do kind of back up a little more, and that's all you get, where do they hit the wall? Do they hit the wall right here at what was this short-term high? If it takes a breather for a couple of days, it comes back up. Is that the wall, and it rolls over from there? Does it keep going, right? Do they come up to these higher levels? Do they come back towards the highest high? I don't think you can rule any of that stuff out just yet And I don't think anything's terrible yet. I mean, it could develop that way. I just don't see anything yet. Remember, now the Qs, of course, also are up above all of your SMAs, and most of your long-term SMAs are rising. And even, right, a lot of these shorter term ones, even the 50, they all now appear to be rising again, right? So that's really the SMA profile that you want if you're a bull, right? That, hey, all the slope of all these SMAs is rising. Though the price action is just over all these various time frames just is continuing to show itself to be more bullish than anything else. So keep that in mind. I still think there's more room to run or fall, right? That's just obvious from my comments, but just wanted to make that clear. I think, again, reiterate the dollar and the TNX, keep your eye on them, because I think that's really the key to this whole thing at the moment. If they both power through the recent highs like we showed, like that to me is, you better be ready for some defensive maneuvering at that point, or aggressive downside playing. I still am not buying what these perma bulls are selling. I still hope to be wrong. I still think there's a lot of key things I'm focusing on that are not supportive of the equity market. And I think that the fact that rates are now higher for longer, I just don't see how that's good, especially with inflation not coming down enough. But again, that's me. They do work things, in my opinion, according to the calendar. So remember, there could be, if we have some volatility, they probably could try to resolve that bullishly, thinking that the Fed's going to give them like a nice mother's milk speech on the September 20th. So, and again, just same as it ever was, you got to trade what's in front of you. But really, the Qs, and as we've been noting, and I'll wrap up on this, but the Qs and the SPY, they've just been very similar charts, not exact, but similar charts. And so that's where we are on those in terms of, we have to look at them the same way. Is it a possible lower high put in? Do we just get a little breather? They find support, they start bouncing and go up from there. Can't rule that out. What if support doesn't hold? Then it looks like this was the kind of this move we've seen here over the last couple of weeks. That is kind of the counter trend move, and then you could be on the verge of another leg lower. Again, I'm not saying that at the moment. I think you're just at a point right now where you need more price action and technical data in the form of breadth indicators and so on and so forth to unfold, and then you can start to have a more let's say confident forecast, higher probability or confidence-based forecast. Right now, I don't think you can. If you had to say anything, if we just had to sum things up, you'd have to say, look, we noted there was a higher low here. We noted there was an improving sort of technical picture here last week when we recorded the macro measure, and that worked. So the technicals are working. The technicals are still bullish overall, at the moment. And again, that doesn't mean for Monday. I just mean overall. And because there's just not enough technical damage being done at the moment, or you're not at risk of losing anything key. I mean, really, until this low in the 100 SMA there, that's dashed white, until those are under pressure right now, there's really not a lot to worry about. And that would be, in my technical book, there isn't. And that would be about, right, that's a pretty good decline. You're talking about dropping down to that 432 level that we think is important anyway. So right near there, that's really where I would start to say, if it loses that, that's a problem. 430 to 432-ish. But that's 20 points away. That's 4% plus away from where we are now. And that's even after a rough Friday candle. So you need to fall a decent amount to me before you really are thinking, okay, it's go time to be like a super bear, right? I don't think you're even on the launch pad for that yet. So the other thing is that this is interesting to me because IWM should be pretty rate sensitive, and typically, right? And normally it is, but look at that. That's having a very good week and a very good finish here. So that's proving to be very resilient. It's back above all the SMAs. It's clinging above the 50 there in gold today. And that to me is sort of like a little bit of an anomaly situation where it's like, wait a minute, rates are moving back up today, the TNX. 2-year yields. They're not backing off from the most recent high, which is the highest high we've seen in a while. The dollars, not that that's a big deal for these guys, but these are all, I think, things that are typically bearish overall. And yet IWM really finishing strongly. Unfortunately, we had an idea in that one too, which I'm glad we got in there, because I was kind of like hesitating a little bit on that one, but I thought, you know what, like it might just turn out to be risk on overall. And it kind of did turn out to be risk on overall. I mean, you just never know at the time when some of this paper hits, but it did sort of show up that way. And, fortunately, we did have a chance for folks to play that if they wanted to. Probably the biggest sort of enigma is the diamonds, right? Because they are, right, these are your blue chips. These are the ones with the big time balance sheets. And you wonder, well, what's going on here? How come these can't get going a little bit more? But they're holding, regardless of what I just said, they're holding above all the SMAs, right? So even with today's kind of rough performance, they're holding and hanging out there. And now we just have to wait on, did we just see a lower high that visually that we'll look back on and say, there you go. That was a weak rally attempt in the diamonds, didn't do much, didn't retrace nearly as much as the Qs, nearly as much as SPY. And then shortly thereafter, it lost support of the 50 and virtually all the SMAs shorter than the 50. And that's not good. But for now, what they did though still preserved, I think, the longer term trend, where that longer term kind of monthly candle, that's not something you look at every day or every minute, sure, but it still looks better than it had this closed ugly. So to me, the bulls are still clinging to control by virtue of this strong week that they had here. So I'm not picking a fight against them in a big way yet. If the technicals develop further, sure, we can pick a fight. But it just, to me, you've got to maybe wait a little bit longer. Maybe just could be a couple of days, could be a couple of weeks. We'll see what they're able to do in front of the Fed. But as I said, right, as of right now, the spiders, the virtually everything is above SMAs, almost all of them. And I wouldn't be surprised if we backed up a little more. And then you have to decide when you get to there. And I don't like this chart. It's just too busy. Where's my other chart at? It should be this one. Why is that not showing up? For some reason, I'm getting the wrong, feel like I'm getting the wrong chart. No, it's my own fault. I wanted to it's all the fib levels, and I apologize for that, but they're just, there's a lot of different retracements and so on and so forth going on. But that's what threw me off. But yeah, I mean, coming back in a little bit, finding support, we'll see, right? If they do that and these rising SMAs kind of come up here midweek and hold things and they go again, I don't think you can be surprised by that scenario, nor could you be surprised by rates and the dollar are moving back up. If they start out the week strongly and they bring this thing down and then they just keep going, they just continue to power higher to the north, this could become under even more pressure. And then you'll have another leg maybe start to develop that's similar to this one after having this corrective leg to this downside move. That this corrective leg here would then maybe lead to that next one. And we'll see, though. But I think that's where you are. You're at a we'll see. Let's wait it out. Let's be smart. Let's not get too big. And remember, we have short-term volatility that should be the dominant theme of the next couple of months. That's typically the case in September and October when SEP really starts to get rumbling, after the first week. And then with the lead up to the Fed, there's a Fed meeting right just at this very start of November. So there could just be a lot of volatility. They are volatile months. They're typically not the greatest months, especially September. And then you kind of resolve bullishly. So as long as they keep things buoyed where you're not breaking down below the 100 at this point, or the 432 level in the SPY, as long as that's the case, then, right, depending, if we just assume like an interest rate, or let's call it a TNX dollar DXY neutral state, then I'd probably favor that from this point onward, I'd probably favor the third year play out, right, where we get that third year. And that third year, I might just pull over here for us to see. That's not it. My apologies on that. Oh, where is it, dummy? Is it? I thought I had that. Oh, there it is. So yeah, it would be this right here. Let me pull this over to the screen. So that third year is right above here. So here's your typical third year where you've got your typical pre-election year is in green up here, which is where we are. So notice, right, the swoon in August, September, they kind of bring it up towards the start of Sep. It's kind of volatile in both directions to a degree. October, boom higher, then boom lower, right? So this is what you typically get. Then you finish out strongly. And that's very similar, obviously, to what we're seeing here, right? It's the similar, same data basically crunched up a little bit. And the VIX does its thing, right? Really all the way to that through like Oct and into Oct. And then you've got that early node meeting of the Fed where I guess they deliver the right tonic, right? And then the holiday period kicks in and it's all fun and games from that point on. But that's what we have to expect for the rest of this year. And the reason I would say that we should stick with it is just because this initial part has worked quite well. The timing of everything's been pretty good overall. Couple little sort of divergences from it at times, but overall it's been pretty good. So that's telling you that you should be in for a not necessarily a choppy market, but a trader's market. And you might not get that super strong trending action for weeks and weeks and weeks and weeks at a time. You might just get it for days and days and days. Do the best you can, and then we'll see how interest rates, the dollar, how things play out, and if the seasonality is still on track, and then that cycle's still on track, and then we'll go from there. So I think I'm going to wrap it up on that. I do hope that something that I shared with you helps you out this upcoming week, or certainly some week in the future. And I do want to wish everyone a happy and safe Labor Day weekend. Hope everyone enjoys themselves, maybe get some good downtime. And maybe it's good that I have folks coming into town because that way you can hopefully, if you like to view these videos, you get to catch them a little bit sooner and not have to worry about watching them maybe on later on Sunday, or in this case Monday. But Ryan and I will be back at it, unfortunately, on Monday ourselves, producing all the newsletters like we always do, because they need to be out that day so we can get trading started all over again next week on Tuesday with all the webinars that are lined up. So again, thanks for tuning in. Have a great weekend, everybody, and we'll see you next week.